Most seniors are writing checks every single month for bills they have a legal right to stop paying, and the programs that eliminate those bills are sitting in federal and state law, fully funded, available right now, with nobody from the government calling to tell you they exist. Bill number 1 is the Medicare Part B premium, which runs $202.90 a month in 2026, adding up to more than $2,400 a year pulled directly out of most retirees' Social Security checks. What a significant portion of Medicare recipients do not know is that a federal program called the Medicare Savings Program can legally eliminate that premium entirely if your income qualifies. There are 4 tiers. The broadest tier, called the Qualified Medicare Beneficiary Program, not only removes the Part B premium, but also wipes out deductibles, copays, and coinsurance for Medicare-covered services, meaning your doctor cannot legally bill you for those amounts even if they send you a statement. Under federal law, specifically 42 United States Code Section 1396A, providers are prohibited from billing QMB enrollees for Medicare cost sharing. The second tier, called the Specified Low-Income Medicare Beneficiary Program, covers the Part B premium alone, saving enrolled seniors that same $2,400 annually. The 2026 income limits for the broader tier sit at $1,350 a month for a single person. These thresholds are updated each year, and some states set their limits higher than the federal floor. The Social Security Administration estimates that only about half of seniors who qualify for these programs are actually enrolled in them. Bill number 2 is the Part D prescription drug premium, and this is one that compounds quietly year after year without most seniors ever questioning it. The same Medicare Savings Program enrollment that eliminates your Part B premium also automatically qualifies you for something called Extra Help, the federal low-income subsidy for prescription drugs. In 2026, full Extra Help limits drug copays to $5.10 for generics and $12.65 for brand-name drugs, and it can eliminate your Part D premium and deductible entirely. The SSA estimates the annual value of Extra Help at approximately $5,700 per person. Most people who qualify never apply separately because they assume it requires a separate form or income review. It does not. QMB or SLMB enrollment triggers it automatically. If you are paying a standard Part D premium and drug copays every month without ever having checked whether Extra Help applies to you, that is a bill you may have been writing unnecessarily for years. The SSA has income data that could theoretically identify who qualifies, but enrollment is still a separate step that millions of eligible seniors never take, most of them unaware the program even has a name. Before we get to bill number 5, subscribe now because the last 2 bills on this list are ones most financial advisors never bring up, and one of them involves money that goes straight to a government account the moment you stop asking questions about it. Bill number 3 is the property tax bill, and for most homeowners over 65, part of it is legally reducible or freezable through programs that exist in every single state, but that fewer than 8% of eligible seniors actually apply for, according to AARP. Every state in the country offers some form of property tax relief specifically for homeowners who have reached a qualifying age, typically 62 to 65. The most powerful version is a tax freeze, which locks in your school district or total tax bill at the amount you owed the year you turned 65, regardless of what happens to your home's assessed value after that. In Texas, the freeze on school district taxes never increases once it is set. In Illinois, a program called the Senior Citizens Assessment Freeze Homestead Exemption locks in the equalized assessed value of your home. In New Jersey, the state NJ program reimburses seniors up to $6,500 per year in property tax relief. These are not means-tested handouts. Many of them have no income limit at all. They require an application, and in most cases, that application only needs to be filed once. The seniors still paying the full market rate tax increase on a home they have owned for 30 years have typically never been told this option existed. In Colorado, qualifying seniors receive a 50% exemption on the first $200,000 of assessed value. In Alaska, the first $150,000 of home value is exempt entirely for owners 65 and older. The pattern across every state is the same. The relief exists, the application window opens every year, and the majority of people who qualify never file. Bill number 4 is the federal income tax bill on Social Security income, and this one shifted significantly in 2026. A provision called the Senior Bonus Deduction, passed as part of the One Big Beautiful Bill Act and confirmed by the IRS for tax years 2025 through 2028, gives every taxpayer 65 and older an additional deduction of $6,000 on top of the standard deduction and the existing senior add-on deduction they already qualify for. For a married couple where both spouses are 65 or older, that is $12,000 in additional deductions combined. This deduction is available whether you itemize or take the standard deduction, and it specifically phases out only once income crosses $75,000 for a single filer or $150,000 for a married couple, which means most middle-income retirees qualify for the full amount. The practical effect for many retirees whose income falls below the combined standard and senior deduction thresholds is that the tax bill on their Social Security income can drop to zero, not through a special exemption, but through legal deductions that reduce taxable income below the level where any tax is owed. For someone in the 12% bracket, the $6,000 deduction reduces their federal tax bill by $720. For a couple where both qualify, the $12,000 combined deduction is worth $1,440 in direct reduction. It disappears after 2028, making the current window the only time it is available. Bill number 5 is the Medicare copay bill that arrives after a doctor visit, outpatient procedure, or specialist appointment, and specifically for QMB enrollees. This bill is not legally collectible even if it is sent. Under federal law, once a Medicare beneficiary is enrolled in the Qualified Medicare Beneficiary Program, the provider is prohibited from collecting any Medicare cost-sharing amount for covered services. That means no deductible, no coinsurance, and no copay. If a provider sends a bill and then refers that balance to a collections agency, they are in violation of federal law, and the bill can be disputed directly with the Centers for Medicare and Medicaid Services. The problem is that many QMB enrollees do not know this protection exists, pay the bill because it looks official, and never reclaim the money. CMS takes billing violations seriously, and QMB status overrides a provider's standard billing process regardless of whether the provider participates in Medicaid. So here is what all 5 of these have in common. They are not workarounds or loopholes. They are funded programs and legal protections written into federal and state law specifically for seniors. And the way they stay underfunded and underused is that nobody with a financial interest in them ever reaches out to tell you they exist. Your Part B premium gets deducted before you ever see your Social Security check. Your property tax bill arrives every year at the same time, and most people just pay it. The federal senior bonus deduction requires claiming it on your return, and if your tax preparer did not update their software in time, it may have been missed entirely. Always speak with a benefits counselor, a tax professional, or your state health insurance assistance program before making any changes based on what you learn here. Because eligibility rules vary by state and by income, and your situation may be different from the general examples described. If any of these 5 caught you off guard, drop a comment with your age and which bill you are going to look into this week. And if this helped you see something that was hiding in plain sight, subscribe now, because there is always more money sitting in programs that assume you already know about them.